There's a corner of the stock market the biggest investment funds are legally locked out of, not by rule, by size. Two profitable companies trading under $10 a share are sitting right inside it. One just raised its own guidance twice this year. The other is running a comeback almost nobody has noticed. Welcome back to Wealth Signal. I'm Alex Carter, and today we're breaking down two small-cap stocks under $10 that Wall Street's biggest players simply cannot buy enough of to move the price. Quick note before we dive in. Everything here is educational analysis, not personalized financial advice. Always do your own research. For most of the past 2 years, 7 massive tech companies swallowed nearly 40% of the entire S&P 500's value. That concentration worried a lot of professional investors. Recently, that grip has loosened. Money has started spreading out into smaller, less obvious companies, and the Russell 2000, the index that tracks small-cap stocks, has quietly moved higher over the past year. Here's the part most people miss. Big institutional funds can't buy tiny companies without moving the price against themselves. That single fact creates one of the only real edges an individual investor still has over Wall Street. And, thanks to fractional shares, you don't even need the full share price anymore. You can own a piece of any of these companies with whatever amount you're comfortable with. Healthcare in America is quietly shifting out of the hospital and into the living room. Treating a patient at home costs a fraction of what it costs to monitor them in a hospital bed hooked up to machines, and insurers have noticed. That shift is the entire story behind Aveanna Healthcare, ticker AVAH, a company most retail investors have never even heard of. Aveanna provides home-based care for complex and expensive medical cases, and roughly 91% of its revenue comes from Medicare and Medicaid. Last year, the company delivered 16% revenue growth, and it raised its own 2026 revenue guidance not once, but twice. That's a company beating its own expectations, not just analyst estimates. Aveanna operates in 39 states, according to the breakdown given in our source material. At around a $2 billion market cap on roughly $2.1 billion of revenue, this isn't a giant. And that's exactly why it could become buyout bait for a larger insurer, a bigger home health platform, or private equity looking for a foothold in a growing market. The stock has already climbed more than 120% over the past year, and some investors hear that and assume they've missed it. But in small caps, a big move doesn't necessarily mean the ceiling is close. Institutions simply can't pile in the way they would with a mega-cap name, which leaves more room to run. This is a watch list name, not a declaration to buy. Healthcare eats up somewhere between 18 and 19% of U.S. GDP, and an aging population isn't going anywhere. The sector has underperformed its own potential over the last 5 years, partly because all the attention went to AI and mega-cap tech. But healthcare demand doesn't disappear in a downturn. People don't skip a hip replacement because the economy got shaky. Before we move on, everything I've referenced visually in this video is saved as a downloadable summary file in our Wealth Signal Telegram channel, along with every past and future videos file. Links in the description. Go grab it. Now for a completely different kind of story, one that starts with a near-total wipeout. eGain was founded back in 1997 by Ashu Roy, a Stanford MBA who had previously run a call center in India. The company built customer relationship management software, the tools behind the emails and databases companies use to manage customers, and went public in 1999, right at the peak of the dot-com boom. Then, the stock crashed. Not by a little, by 99.97%. Most companies that fall that far simply disappear. eGain didn't. It executed a 20-to-1 reverse stock split just to stay listed, and then it quietly kept going for literal decades, earning $80 to $90 million a year in revenue the entire time and staying profitable. A couple of years ago, eGain repackaged itself as an AI customer service company. That could sound like a company chasing a trend with nothing behind it, except the retention numbers say otherwise. Its non-AI customers renew at a 101% rate, meaning they actually spend a little more each year. Customers on the AI product are renewing at 116%, though that data set is still new. Ticker EGAN trades at a price-to-earnings ratio in the single digits, and the client list includes the IRS and JP Morgan, real enterprises, not speculative logos. This is still a roughly $175 million microcap, and prices like this can swing hard for no obvious reason. This isn't a large position kind of stock. It's a watch list name you track closely. Customer service is one of the most labor-heavy functions inside almost any company, and that's exactly the kind of job AI tends to actually help with rather than replace outright. SaaS companies broadly got hammered over the past year on fears that AI would gut their business models. But even if AI handles 90% of a task, the remaining piece can still make the software essential. Here's the pattern connecting both of these names. Neither one is a business institutions can load up on without moving the price against themselves. That's not a coincidence. It's the entire reason small and micro-cap investing still works for individual investors when almost every other edge has been arbitraged away by bigger players. That doesn't mean betting big. Historical research on U.S. stocks going back a century found that only a small sliver of companies accounted for almost all the market's total gains, while a large share of individual stocks lost money for investors outright. The takeaway isn't to avoid small caps. It's to size any single position small enough that being wrong doesn't hurt you. This is my list based on research into 2 companies with real revenue, real profits, and a genuine reason institutions can't easily crowd in. Your situation might be different, and I'm not a trader telling you what to buy. Always do your own homework before putting money into anything. If this kind of small cap breakdown is useful to you, hit like. It tells YouTube to show this to more people who need it. Subscribe with notifications on, because we cover a new stock story like this constantly. Drop a comment telling me which of these 2 you'd want a deeper dive on next. And if you want the visual summary file for this video, join the Wealth Signal Telegram channel. Link is in the description.